Good morning, everyone. My name is Johnathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to talk about the CPI report and hopefully some other stuff, hopefully get into a little bit of housing. Our guests today are Daryl Fairweather, chief economist over at Redfin, and also the author of a forthcoming book. And my colleague, Allison Schrager, also senior fellow at the Manhattan Institute, and another book author with us, of course. So, guys, we're going to get into this in just a couple of minutes, but the news of the day here is that we are expecting CPI headline to come in at about 2.9%, which on a year-over-year basis would represent another deceleration. The big question coming off of the back of the Fed decision recently is Jay Powell and the rest of the FOMC going to see enough evidence to start looking at cuts? Maybe a little bit later in the year. He's sort of taken March off the table already, looking at May, but that's the big question. Jay Powell has said he doesn't necessarily need to see better evidence, but he needs to see more of it. So on the spot, I guess the big question here is sort of where are we in this inflation journey? I guess, what is your inflation story to start with? What have been the drivers? What are the drivers today? And what is your inflation story going forward?
Sure, I'll go back in time a little bit. I'll start at 2022, which is when inflation started to get out of control, reaching heights not seen for decades. And there was a lot of debate amongst economists over whether this inflation would be temporary or whether it was something that would be harder to get a hold of. And I think where we are right now is that it's been a combination of both. It seems like some parts of inflation have faded away. Rents, for example, in our data have come down, even though it's not necessarily showing up in the inflation data just yet. But it seems like overall inflation is headed in the right direction, but we aren't at a place where we can declare victory just yet. We're not at that 2% target just yet. And I don't think the Fed is going to declare victory until they have some conclusive evidence that we are there. So that's what we're waiting for right now, is just more consistent evidence that inflation really is a story of 2022 and 2023 and not one that's going to be a problem moving forward.
Okay, fair enough. Allison, how have you updated your priors about the inflation story since the last time we chatted?
I'm still optimistic it will continue to go down, but I think also sort of a little worried that some things could restart it, but I haven't seen them yet, or maybe just be a little stubborn. Particularly wage growth remains pretty vigorous, which could keep inflation up. But as Daryl pointed out, rents coming down is going to be a big contributor to making it at least appear like service inflation is coming down, because the CPI numbers are slow to incorporate that, and that's a big part of it. So I think we'll probably see a good couple next reports, bar some big shock happening that throws us off. But I'm still worried that, again, maybe not the last mile anymore, but maybe the last half mile, just because of wages, might be a little tough.
Okay. And when you guys are looking at the Fed outlook, do you sort of agree with my setup? It doesn't take a genius to read the tea leaves that March is probably off the table. Jay Powell effectively said as much. It's clearly not his base case. What would be your base cases at this point? Do you think we're good to go in May, unless we get some shock that forces the Fed to rethink that?
When the Fed says that March is off the table, it's kind of like when I tell my 5-year-old son that, only one cookie, not two cookies. Like ultimately, the market is what decides. And if the market decides that they need to come down faster, like perhaps inflation is shockingly low, I think that's unlikely. But the Fed doesn't get to say that March is off the table until March is already in the past. Like, it's always on the table.
All right. All right. Well, we will see now in about 20 seconds whether cookies are on the table for March or not. As per usual, we'll be looking particularly closely at that core figure. We'll see if that month-on-month pace is stable or maybe even decelerating, and those numbers should be populating right now. So there you go. So the first thing I want to draw your attention to is core CPI month on month comes in at 0.4%. So that is a little bit higher than the consensus Wall Street expectation. And, people say that these markets have been priced for perfection. And given that, you may potentially see a little bit of upward pressure on yields as a result of that. That's my gut reaction to this number coming out right now. Looking at this on a headline year-on-year basis, what you get is 3.1%. We don't break below, what would have been that psychologically important 3% level. So, surface level feels a little disappointing. Daryl, do you have an immediate reaction to this coming out here?
Yeah, this is
Obviously, you
not.
haven't had the opportunity. Go ahead.
This is above expectations, so I think that means it's bad news. It's not the worst news in the world because it's not that high above expectation, but I would have preferred to see at expectation or below. I think, like you said, this is probably going to push up yields, push up rates. But yeah, we don't know how long this fight is going to take against inflation. The economy is really strong, and a strong economy tends to push up wages, as Allison was stating earlier. So I don't think it's too surprising, just a little bit disappointing.
Yeah, I did put up on the screen just so we can get the market take, and you do see that that intraday chart on yields jumping quite a bit. We were trading about 4.16% around the time of the report, and we've now moved up about 10 basis points in the space of just a few seconds. And this doesn't feel, sometimes, it's computers trading these things, and sometimes the algorithms cause crazy things to happen immediately. This doesn't feel like the sort of thing that's going to immediately reverse itself. But I will, lay out one possibility here before we dig into the numbers. I try to read a bunch of the sell side reports before these things come out. And Goldman Sachs did have one of the higher projections on the street. They saw a 0.4% coming down the pike. And their argument was essentially a version of excess seasonality. They said, we're coming out of this inflationary period. There's still some catch up to do, and companies and other price setters tend to do that kind of catch up in January. So they thought that we would get what was essentially you might call a one-off January effect in categories like prescription drugs, car insurance, tobacco, medical services. But if you read the Goldman report, they were not like freaking out about this. They were saying this might happen, it might be a one-off, but we still see disinflation proceeding more or less apace for the rest of 2024. So that's my sort of optimistic take on a report that Wall Street is taking sort of pessimistically right now. Let's well, let's get back into a piece that you wrote recently, Allison, that we were talking about offline before we came here, and I really enjoyed. And your take was kind of like disagreement in forecasts is actually a good thing. A little bit of uncertainty, a little bit of dispersion in forecasts is kind of a good thing. And we'd all gotten used to this like overly predictable world, especially in the sort of 2015 to 2019 period, and we're going back to something more normal. like where does this report fit in the context of that theory that you sort of laid out in your recent column, Allison?
I think it's why it's healthy to sort of remember that we live in a world now where, a lot of macro variables we've taken for granted of being very low and stable and never very exciting are just going to maybe be more exciting going forward. I'm optimistic inflation might, continue to go down. We might have some rate cuts later this year, but there are big sort of structural issues on the horizon that suggest that inflation might not be as predictable as it was, say, the last 10 years pre-pandemic, or we might have a much more interesting bond market. So, I mean, when you have sort of a wider range of things that can happen, you also have a wider range of views of what to expect. And that probably is more healthy. On the one hand, the Fed has had this very powerful tool the last 10 years. It really is a big believer that expectations are one of its most powerful tools to move markets. And if expectations align and they are what the Fed wants them to be, then monetary policy can be very powerful. But if we have a bigger dispersion of expectations, then the Fed also has less power and is maybe being less effective. But on the other hand, that might just be the reality, is that we are going to be in a more sort of unpredictable inflation interest rate environment, just as we have been for, most of the 20th century. So, I said, I think this is, we're not talking, this is like not a great surprise, but it's also not, as Daryl pointed out, wildly out of line with what people expected. So I think it's a reminder that we really don't know the future. And, but at the same time, it's people aren't totally far off.
Yeah, I did want to dig into the numbers a little bit here, and I put up a graphic that we produce in house here. The Bloomberg economics team puts this together, and it's available on the eCan function on Bloomberg. But basically, so this is your breakdown of the components that are contributing to core CPI month on month. And if folks can't read the text, the red is your core services contribution, which accounted for basically 0.51 percentage points month on month, seasonally adjusted. And your blue is the core goods, still a drag from core goods, right? In other words, prices of stuff is going down, but this core services category is still causing us some problems and some indigestion. So I wanted to dig into that a little bit, and sort of like surprise, but also no surprise. This is Daryl Fairweather's wheelhouse right here. So this. I never know what to call this color. What is this color, Allison or Daryl? This is like a light purple lacquer.
Oh, lavender.
Lavender.
Oh,
Yeah.
lavender. Yes. Okay. So our lavender bar, which which represents the shelter component, took a big step up month on month, and boy, is that curious. Let's sort of linger there for a little bit. So rent of shelter contribution up in a pretty meaningful way, and that is coming from owner's equivalent rent, actually. Rent of primary residence declines, but owner's equivalent rent goes up. Huh, that's a head scratcher to me.
Yeah,
Any
actually, I
theories?
think so. From what I understand, the way that they calculate owner's equivalent rent is that they call up homeowners and ask them, how much would you charge to rent out your home, or something similar to that. So it's not something that I think a lot of homeowners know how to answer unless they are really paying attention to the rental market. And I wonder if this might be a consequence of owners feeling like understanding that the mortgage rate they got is not reflective of the rent that they could charge. I think maybe last year owners didn't get that they could rent out their home for a lot more than what they're paying in their monthly mortgage. But now, as homeowners are looking at perhaps retiring or moving into a new home and they'd have to pay a higher interest rate for that new home, I think they're starting to learn what the value is of their home a bit more accurately, even if they personally aren't, their payments aren't changing, because most homeowners have fixed rate mortgages. Maybe some are taking out HELOC loans or other things that might be pushing up their monthly payments. But I think this might be a bit of homeowners learning how much their homes are actually worth in a rental basis now. But asking rents from our data, like apartment buildings that are being listed on the market on our website, rent.com, those rents are actually stable. They were going down for the last 3 months, and then this last month it was flat. So I don't think this is really a reflection of the change in what people could get if they were searching for a rental right now. It's more a reflection of homeowners understanding how much more their home is worth now in rental value than it was when they first got it.
We've been told now for 18 months, probably 24 months, respect the lags from market rents and market trends in home prices to the CPI's shelter component. But it's getting hard to wait, I gotta tell you.
Well, the lags are coming. I think the lags are going to come in waves, because this seems like a lagged reaction to the increase in housing costs that were happening last year or even in 2022, not necessarily a reflection of rents going up in the last month or even home values going up in the last month.
Sure. Let's see what other information our graphic has for us. So transportation services takes a leg. That can be a volatile component. I don't know exactly what's moving it, but it does include like airfares and stuff, which move around with energy prices and so forth. Medical care services has a pretty big move. That was one of those things that Goldman Sachs told us to watch out for with the so-called January effect, and you do see a larger than has been typical contribution from that. So maybe if you're buying Goldman story, you take some comfort in that. But that's essentially the story as we have it here. Daryl, like, let's bring this back to your world. We just saw a 10 basis point move in 10 years. Typically, that translates into a 10 basis point move or more in the mortgage market. What do stubbornly high mortgages mean for America at the moment, you think?
Starting off this year, asking prices for homes are up about 5%. And when I saw that, I thought I was kind of surprised. Our forecast for the entire year was for home prices to be down 1%. So I think that there might be two things that are happening in the housing market. One is a shift towards higher end, more cash rich sales. So if people are feeling good about the economy, their stock market, the stock value is going up, they might have more cash to put towards a home, and they are more insulated from the effect of mortgage rates. So that makes sense. And also the California market is recovering now, and homes out there are high priced. So a bit of a shift towards higher priced homes in the market. But I think a part of it too is homeowners may be asking for more than what their home is worth. And we might see more price drops, or homeowners start to get in line with the market more in the spring. It's still early, only February right now. So I think these higher rates might give sellers a bit of a reality check when buyers are struggling to come up with the money for high asking prices, unless they have a lot of cash that they're coming with.
And so, do you think that the spring will be sort of an inflection point, as it were? I guess spring is typically in the housing market when a lot of people like to list their homes, right? Their lawns look extra nice in that time and so forth. Is 2024's spring season shaping up to be an inflection point for the housing market? Do you think we'll feel like we know a lot more about the trajectory of housing after the spring?
No, I think
No.
2024 is still going to be a weird year, They're going to have slightly more sales than we did last year, but last year was a record low for sales. And I think that there's still this issue of homeowners having this mortgage rate lock-in effect where they feel financially worse off if they were to sell and buy again. And if rents start to go up, which they might, then that would be another reason for homeowners not to sell and go to a rental. So I think that there's still a lot of stickiness in the housing market caused by this difference between the rates that homeowners have and the rates that a new home buyer could get. That's going to fade over time, which is why we're expecting more sales this year than last year. Like people need to move on with their lives. Big life events like a marriage, a divorce, a death, a retirement, those lead to home sales. And you can't plan around those with mortgage rates. But as long as rates stay high, I think the market's going to be slow from a historical standpoint. The fact that owner's equivalent rent is going up, I'm not really sure what to make of that in terms of homeowner behavior. Like it seems like homeowners are starting to understand that they that housing has gotten more expensive, even if it's not personally more expensive for them given their low mortgage payments. But if they're starting to feel the pressure from other debts and they feel like they aren't able to tap their home equity the way that they were able to when mortgage rates were low, that's going to be a drag on them too. So yeah, I think it's going to still be a tough market this year all around.
Yeah, yeah. So like the way I've been thinking about the economy and the inflation story here, my story is it's kind of like a seesaw. Like you need inflation to come down and rates to come down to keep the real economy humming along here. And there seems to be like a bit of danger that maybe it just takes a bit too long to happen, and that allows more and more cracks to emerge in the labor market and stuff, and perhaps like a vicious cycle emerges. Like in terms of the timing of when the rates start to come down in that potentially virtuous cycle for consumers and home buyers and all of that stuff, like is there, do you have a point circled on your respective calendars when you say like, geez, like if the Fed isn't cutting by September, boy, am I worried. Or if the Fed's not cutting by December, like, boy, are we in trouble. Like, Allison, what do you think of my framing? And do you have such a date circled on your calendar?
No, because I fear it's never coming. Like, I mean, not that the Fed's not going to cut rates. Like, I think they will. I think that will provide some relief. But as I said earlier, I think there are structural reasons to think we might just be in a higher rate world. I don't think that the Fed has control over interest rates, but only to some extent. I mean, there is that magical, like as you've written about very well, the term premium. And, if we're in a more uncertain inflation environment, if we're sort of in some aspects of an aging economy, a higher debt economy, then, there are reasons to think that the 10-year is just going to be structurally higher no matter what the Fed does. And as you said, like where the cracks show is largely around the 10-year. That's mortgage rates. That's um, um, impacts a lot of the commercial loans, a lot of the corporate loans. So while they might get some relief this year, I mean, I think a lot of that maturity wall, which is like, over the next 5 years, might have problems even if the Fed does cut very aggressively.
Okay. And of course, like part of it too is, uh, in some ways, it doesn't matter what the Fed does, right? Like if the market thinks the Fed is cutting at its own peril and inflation expectations rise, then 10-year bond yields may still be high and mortgage rates may still be high, right? But like I don't want to believe your story, Allison, because the implications are very uncertain and in some ways kind of scary. Like, so
Well, I mean, one way you could be optimistic about it is like
uh,
maybe a world like the 10 years we had of near zero rates, just like we're sort of an aberration I don't blame the Fed for that. I think that was largely market driven for a lot of reasons. I don't blame
right,
policymakers for that, but there were just things in the market that made rates go very low for a long time, and those things don't always last. So it's not necessarily bad. It's like I was saying about uncertainty with forecasts. Sometimes a non-zero rate is maybe in some ways just more natural and puts a more sensible price on risk. So it's not necessarily bad. It's just different from what markets have become used to.
okay. So Daryl, Allison says we should be prepared for sustainably high rates. How does this housing market affordability issue work itself out in that world?
The housing market can survive a high rate environment, especially if the economy is strong. Like we're already seeing a shift towards more cash purchases, and that's true at the luxury end as well. So it's not just people buying cheap homes in all cash; they're buying very expensive homes in all cash. So I think as long as the economy is strong, people will buy homes. Buying a home is like so tied up in class identity in the United States that when people get money, they want to spend it on a better home typically. So I think that the challenge for the housing market is the mortgage rate lock-in effect, and that's probably just going to fade away over time without rates coming down significantly. And I think the possibility of rates coming down significantly to wipe away the mortgage rate lock-in effect, I think that's very slim, a very slim chance. Like we would need a severe recession. And that's not something I want to hope for anyway. So I think home buyers just need to uh, like understand how a high rate environment works for them. It means that it rewards buyers who are either paying in cash or putting down large down payments. If you're putting down a low down payment and you're paying PMI on top of that, it's going to be very expensive. Perhaps you'd be better off renting, and that may in turn push up rents and change the rent or buy equation later on. But if you do have a low down payment, I would advise people to seek out down payment assistance programs or FHA loans or other things that can bring down their costs, because I think this market is going to favor cash.
Yeah. And I do also wonder about sort of the knock-on effects for the rest of the economy when the housing market does actually loosen up a little bit more, because it seems at least theoretically true that a lot of consumers who have not been able to spend on that house that they thought they would be buying at this point in their lives are buying other kinds of maybe even like consumer goods, and you might say, I don't necessarily know if this is has been very meaningful empirically, but it seems theoretically true. But yeah, you may say that like maybe that's what's been bolstering some of the strength in like apparel or what's something else that's been doing amazingly well, like concert tickets, live sports. Like there are a lot of areas of our economy that are doing shockingly well. And a decent theory for why that is like people had this pot of money that they thought they would be spending on a house and they're not for the foreseeable future. So they're spending it on other stuff. Like, do you think that's crazy? And do you think that maybe flips when the housing market starts loosening up a little bit? What do you think, Allison?
It could be. I just spent last week spending a lot of time on personal finance TikTok to learn how the youngs think about money. And the thing that like really shocked me most is the advice wasn't terrible, most of it, but the weirdest thing I heard is like it's very common to suggest to like Zennials that they should live at home. Like even if like their lives are not in like a disaster, like they have a job, they can afford rent, just like live at home, save some money. And like this would have never been suggested when I was young. I mean, that's only something you do, as I said, if you lose your job or you get a divorce or something. So they're talking about, oh, well, because you can save all this money and then have all this, you can save more and you can spend more money on the sort of consumer goods. So I don't, and there is evidence that living at home is more common among young people, and it's always been assumed that's because rents were so high. But we're talking about people who could afford it, and as a way to, as I said, free up your money to have great experiences and other things. So it could be like something of a structural shift that, particularly when you're young, you do spend less on housing and more on consumer goods. I mean, I haven't delved into the data that deeply if that is an offsetting effect, but it might explain part of it.
Yeah, for sure. So I do want to start wrapping up here. I will to sort of put a pin in this. I'll put our chart of the 10-year back up here. And hey, it was not a glitchy algorithmic move this time. The market got it right in the first instance, and it is holding that sell-off in bonds, which effectively pushed 10-year yields up about 10 basis points. And so, like, if we could we just go around the horn here and have some sort of like snap reactions in terms of summing up what we've talked about here and saying how, if at all, you might be updating your priors about the inflation story after seeing today's number. Allison, can I put you on the spot first?
Sure. I mean, I said like I'm agnostic on what to expect, but I think markets, what we see in this picture, are coming to that hard realization that they weren't getting, a full basis point, 100 basis points of rate cuts this year, and they might be getting some, but I think this is the acknowledgement that maybe they were a little too optimistic on that one.
Yeah, there was one point where the market was looking for, I think, 150 basis points of cuts. So yeah, we were maybe due for a reassessment of that. What do you think, Daryl?
Yeah, I'm back to where I was at the beginning of December before rates came down, where I think that maybe the optimism that was happening towards the end of 2023 was a bit over optimistic, and this is just a bit of a reality check that we need more consistent data. I think Jerome Powell was probably spot on there. So yeah, we just got to keep waiting.
Yeah, and for what it's worth, I think I'm basically with both of you. In the last summary of economic projections, the Fed had said that it was expecting potentially 3 cuts in 2024. So it always seemed like the market had gotten ahead of itself in forecasting 6. I take some comfort in that Goldman note. I'm glad I read it before we got on today. It's calming my anxiety a little bit. And I think there's a plausible story where, this is not a reacceleration. It's sort of another glitchy thing. And like data is weird on a month-to-month basis. You cannot get too excited about a single month.
One last thing is that the
Please.
fact that most of it, or a good portion of it, is coming from owner's equivalent rent, which is based on survey data. I wonder if the market's going to take a look back at that and just be a little bit more skeptical about the volatility in that figure and whether that's something that is problematic or not. It seems a little bit like owner's equivalent rent perhaps is noisier than the other metrics.
100%. If you're getting worked up about a bump in owner's equivalent rent, in any case, thank you very much to my guests today, Daryl and Allison, and thank you very much for joining us on this CPI Tuesday.